Good morning and early afternoon. Happy lunchtime. Second cup of coffee time. Welcome. Thank you for joining. I hope this group is ready to learn a little bit about some tax deductions and ask some great questions. Where is everybody calling from? Feel free to start some chatter. Illinois, welcome, Billy. Arizona, LA. What's for breakfast? What's for lunch? SF, Carrie, I'm in SF also. Welcome, welcome. Hello from Illinois. Hello from Corpus Christi. Someone had yogurt for breakfast. Brownies and coffee. That's my kind of breakfast. Who was that? You're in Hawaii. Madeline, you're doing it right. Hawaii, brownies and coffee. I love it. Welcome, welcome. Tuna fish sandwich. Michael, do you put relish in your tuna sandwich? That's a new thing for me. It's pretty good. Oatmeal and blueberries. That's what I had, Tidra. Well, welcome. Thank you. I don't know how that happened. Today, we're talking about a new subject. If you've been to one of our webinars, we haven't touched on this in a webinar format before. So I'm really excited to share all of this with you all, and I hope you've got some great questions. The format of this webinar is real short, 10 minutes on a couple of slides, and then we're going to pivot over to questions. So if you've got questions that come up throughout the presentation, please use the Q&A feature in Zoom. Put your questions there. If you put them in the chat, we might miss them. So my colleague Sarah is going to redirect you to the Q&A, and we'll make sure that we get answers to your questions. But we're going to dive in. Welcome, everybody. Let's see, is the sound working now? I show that I am not muted. Let's see. There we go. Okay, we're testing out a new mic as well, so I appreciate the feedback. All right, here we go. So we're talking about write-off rules, home office equipment, and business use of your vehicle. Real quick about Collective. If you haven't seen our ads, what do we do? We're an all-in-one platform specific for self-employed individuals, even further solopreneurs. So businesses of ones who want to elect S Corp tax status, and we help you with, forming your LLC, filing the S Corp election, and then we pivot over to everything you need to maintain that S Corp. So monthly bookkeeping, you need to pay yourself a salary, so you've got payroll, and we help you file your business tax return. So all-in-one financial solution for self-employed people. Here's what we're talking about today. Home office deductions, a really high-level overview. You will get a copy of this recording, so you'll be able to see the slides again. We're going to talk through furniture and equipment, how to deduct larger purchases, touch a little bit on depreciation, and then we're going to talk about a really hot topic, business use of your vehicle. So we're going to run through these slides relatively quickly so we have more time for Q&A at the end. Real quick disclaimer, I'll leave this up for y'all to read, but this webinar is for educational purposes only. Okay, so home office deductions, what counts and what to avoid. I'm sure most of the folks on the call have heard of home office deductions. In short, if you work exclusively from home, the IRS allows you to deduct the business portion of some of those home office deductions. So the first step is determining if you qualify. Are you eligible for this deduction? The tax code has some very specific, gritty, list of qualifiers. The high-level summary is that the space should be your primary place of business and it's exclusively used for business. So for those of us who work from home, if you've got that spare bedroom that you converted to an office, that could qualify. And then regular use. So it's used consistently. It's your only space for business. So you're not also going into an office and then, at nighttime after dinner, you're working in that office. It's exclusive and regular use. So one, determining if you qualify. Then how do the expenses become deductible? Not listed here, but the IRS lets you deduct, a portion of your normal personal or home expenses. Think mortgage or rent payments, homeowners and insurance, utility bill, internet, landscaping, anything that you pay for your home may be eligible to be included in this deduction. And then you apply a business use percentage. So calculating your deduction, you can do it in one of two ways. And this is a similar concept that the IRS allows, where there's a simplified option. It's going to be similar for the business use of vehicle. There's a simplified way to make a deduction, and then there's a regular or more complex way to make the deduction. And typically the IRS lets you optimize between whichever yields the greater deduction. So it's nice to know that there's options, and then you can consider either. So in terms of calculating your home office deduction, the easy way is you apply a flat dollar amount to your total square footage of that space. I think it's inflated or adjusted every year for inflation, but $5 per square foot with a maximum of 300 square feet. And that's the simplified way of making a home office deduction. The regular option, which I've seen more commonly, is where you compile all of those various expenses, renter mortgage, insurance, landscaping, and then you calculate the percentage of your home office space. So let's say this 100 square foot room out of my 1,200 square foot house is my home office. That becomes a percentage that you'll apply to that list of deductions, and that's what becomes deductible. So, if you've got a relatively large home office or a high mortgage interest payment or high rent payment, the regular option might yield a greater deduction. So you want to know, which option is best for you. Some red flags. So we touched on this in the qualifying portion. If you have a home office and a co-working space, or you may not be able to double dip. So consider, is your home office primarily and exclusively used for business, or are you primarily working in the co-working space? In which case, that WeWork subscription becomes the deductible portion. Another flag is claiming too much of your house. So, if 50% of your home is being declared as a home office deduction, the IRS could question that to decide, are you really dedicating half of your living space, with your partner, with your kids, exclusively for business? So there could be some risk in claiming too high of a deduction. And then lastly, your home office deduction can't put you into a loss. So your home office can't exceed your income. Your deduction can't exceed your income. If you've got home office expenses that do exceed your income, they would just carry forward to the next year. Amanda, you've got a great question. If you don't mind moving it to the Q&A, and we'll make sure we answer that. A question that's come up often is, I pay rent. Am I still qualified? Yes. So if you're a homeowner, the mortgage interest portion would be what you include in those eligible expenses. If you pay rent, then that rent would be what you include in that eligible deduction, and then you apply the business use percentage. Great questions there. I think we've already got a handful of questions, so we'll make sure that we answer those at the end. Furniture and equipment. So how do you deduct bigger purchases? First, let's define what's a larger purchase. The IRS set a threshold. If any single piece of equipment or furniture or an asset is more than $2,500 for one unit, then it could be considered a depreciable asset. So what does this mean? A depreciable asset is something that goes on your balance sheet. It's what it contributes to the value of your business. It's an asset on your books. And so when something's over $2,500, we need to depreciate. Depreciation is taking a deduction over time. So instead of regular deductions where like I paid for a notebook. I'm going to write off that $3 on my books as an office supply expense. Where depreciation, let's say I buy a $3,000 MacBook. This is over this $2,500 threshold, which means the IRS wants me to take that deduction over a period of time. So that's what depreciation is. It has to do with the timing of claiming a deduction. So deduction options, the simplest, this is what we're the most familiar with, is regular expensing. You write it off when you buy it in full. Regular depreciation says you apply kind of two parts. One, what is the life of this type of asset? The IRS says machinery and equipment, a 5-year life. And so I'm going to depreciate my $3,000 MacBook Pro over 5 years because it's over $2,500. So I'm deducting the cost over time. Then there's this concept called bonus depreciation, sometimes referred to as accelerated depreciation. You might hear of Section 179, which is another form of accelerated depreciation. What does this concept let you do? If a purchase is over this $2,500 cost per unit, bonus depreciation will allow you to deduct the full cost in the year that you buy it. So it lets you mimic expensing while still depreciating the asset. So it's still going to be an asset on your books, but it's letting you accelerate the deduction in the year that you buy it. I want to highlight this because this is something that changed with the new tax bill that passed. Bonus depreciation was, yes, Shelby, I can say that again. So regular depreciation, you take a deduction for an asset over time. The IRS wants you to space out that large cost over a period of time that they determine. With bonus depreciation, what it does is, let's say you still have an asset. I still have a $3,000 MacBook. It's still considered a business asset, which means it should go on my balance sheet. It's going to inflate the value of my business. But depreciation, and then further the concept of bonus depreciation, is a concept with the IRS that lets you deduct the full cost of that laptop while still being a depreciable asset. So it's still going to be an asset on your books rather than like a write-off on your profit and loss statement. But depreciation, accelerated depreciation, lets you deduct the full cost at once or in the year that you purchase. Mark, good point. Not all, there are limitations. So there's always an asterisk on the tax code. There's limitations on the type of asset, whether you've got an income or a loss. Some states don't follow bonus depreciation. So again, like this is just conceptually your specific situation, needs to be considered and whether or not, you're eligible for bonus on a particular asset. But bonus depreciation, in short, it lets you deduct the full cost of an asset immediately instead of over time. So bonus depreciation, why is this a big deal right now? So with the new tax code that just passed, bonus depreciation, 100% bonus depreciation was set to expire in 2025. It was phasing out to where it was, a lower percentage that you could deduct in the year that you buy. 100% bonus depreciation is now permanent, which means, you could have been limited by bonus depreciation. Well, now the 100% bonus depreciation is back, which means you can deduct the full cost of, maybe you're buying a bunch of new equipment for your photography business. You can deduct that camera, that laptop, the editing software, all in 1 year instead of spreading that deduction out over time. Now, business use of your vehicle. And again, like we're keeping this like super high level, various facts and circumstances need to be considered. So just, general awareness, and then we can pivot over to questions. Business use of vehicle. So similar to home office, we want to consider what's the business use percentage. Not all of us have a dedicated business only vehicle. Some of us have, maybe you've got kids and the van is used for soccer practice, but when you're not with the kids, you're commuting to show houses. And so we call these mixed use purchases where there's a business purpose and a personal purpose. So that concept kind of applies to both this home office and the business use of your vehicle. There's a couple ways similar to home office in how you deduct your business vehicle. So for starters, let's make an assumption. Let's make an assumption that your business vehicle is used for business more than half the time. Maybe it's 70% business use. Then you decide, how do I deduct my car? There's two methods. The standard mileage rate is the simplified method, where the IRS publishes the mileage reimbursement rate every year. It's adjusted annually for inflation. And then you log your business miles every year, and then you apply, 70 cents per mile, and that becomes your deductions. That's the easy way. The alternate way is tracking actual expenses. So if you're going to pay, if your car's on lease or your car's on loan, maybe the vehicle interest, your insurance, oil changes, tolls, gas, all of those in the actual method can be tracked and tallied. And then you apply your business use percentage, let's say it's that 70%, to that total cost. And so we've got examples here at the bottom. We use 60% in the example, but you can optimize between either of these methods. So that's similar to the home office deduction. If you choose one method, I believe it's the actual method first, you have to stick with it. So you can't go back and forth if you start at either option or one of the options. So just being aware that there are choices. You can keep it simplified, or you can track all your business expenses and apply your business use percentage to claim a deduction, whichever is higher. As usual, in any instance where you're writing something off, you want to keep a log. So mileage log, maybe there's an app that you use to track your business mileage. If you're taking the actual method, you will want to keep detailed records of your gas, your insurance, tolls, and all of that. Pro tip, commuting between home and regular work is generally not deductible. Shelby, great question for the Q&A, but real quick. I don't believe there's a maximum deduction, but similar concept to home office, where if you're going to be claiming a large percentage, let's say it's 100% business use of vehicle, you're going to want to document the position, because the IRS could say, well, is this your only vehicle? Is this truly only used for business? Do you have dependents? So you just want to be mindful in the business use percentage that you're applying. And that was it for the slideshow. We're going to pivot over to the live Q&A. I'm going to leave this screen up for just a quick minute. If you're interested in booking time with one of our advisors, you can scan this QR code. Sarah's also posted this information in the webinar chat. It's a link to book time on our calendars. There's a promo code that's available. It's $200 off with code Sun Savings. And we're just going to leave this up for a second, and then we're going to pivot over to the Q&A. There are 40 questions, and we've got about 12 minutes. If you've got time to hang on, we typically go maybe 5-10 over, and you're welcome to stay on, but we will record the answers to your questions so that we can post them up on YouTube. All right, so I'm going to stop sharing my screen. If you haven't had a chance yet, scan this QR code, write down this promo code. The links are also in the webinar chat. And let's dive into the Q&A. 42 questions. And before I pivot over, Mark, you asked a great question. What is collective offer? If an S Corp is the solution that you're looking for, you're a single-owned service-based business, collective can help you with business formation. So we can do LLC setup, elect S Corp status, and then we pivot over to the operating side of S Corp. So we do monthly bookkeeping, set you up on payroll because you have to take a reasonable salary. And then we prepare and file your S Corp tax return annually. So it's one app, one login, one fee, everything you need to maintain the S Corp election. All right, we're diving in. There's a couple of other questions in the chat. If you can put them in the Q&A, we're going to get started. All right, so Doris is asking, can I amend my previous tax return and write off business expenses from last year? If so, how? That is a great question. Yeah, the IRS allows you to make amendments to your tax returns if something's wrong or incorrect or missed. There is a statute of limitations, but if it was last year, that wouldn't apply. You'd be within the window. Just make sure that you're documenting what was missed and you've got records that can support, the increased deductions that you're going to be claiming. If you filed an S corp return, Doris, you would probably make the amendment on that S corp return. And then it might trigger amending your personal return as well. So just consider, how did you file last year? If it was on Schedule C, all on one tax return, there's nothing to prevent you from amending and claiming an eligible deduction. Amanda's asking, how much can I write off of our cars? Is it okay to write off cleaning of your house since it is our office? Depreciation of our computer. So your vehicle, you'll want to decide, what method for writing off your car is best. Is it the standard mileage where you just apply your business miles to that 70 cents per mile? Or do you want a more detailed write-off where you compile everything you paid for gas, repairs, oil changes, tolls? You can depreciate your car under the actual method. So the actual method may yield a greater deduction, but it does require more work. There's no cap if you've got eligible deductions and you've got a reasonable business use percentage that you can substantiate. There may not be a limit on the deduction. Amanda's also asking, can you write off cleaning of your house? Yes, house cleaning can be included in the list of deductions, and then you would apply the business use percentage. Depreciation of your computer. Yeah, depending on the type of computer, if it's under that $2,500 threshold, it may be a regular expense where you just, write it off under office supplies or small office equipment. If it's a big, robust, I don't know, gaming computer, maybe you're a content creator and you're a gamer, maybe you do depreciate that computer and maybe it's eligible for bonus depreciation. Mitchell, yes, a copy of this recording will be posted on YouTube and be sent to you after this session. Anonymous attendee, would I qualify for the home office deduction if I'm running an e-commerce business from the spare bedroom in my apartment while also working a W-2 job? I'm looking for deductions for my Schedule C income for the yeah, so you'd want to decide, does this space, the spare bedroom, is it considered a qualified space? Does it meet the, exclusively used for business, primary place of business check mark? It does sound like you have a true self-employed business activity. So yeah, you may be eligible. This does present a great question. If you are a W-2 employee, not of your own S corp, but like of a corporate job, the IRS does not allow you to claim a home office deduction as a W-2 employee. It's only for self-employed activity. Amani's asking, does this home office deduction apply when you see clients outside of your home? That generally, yes. If you work from home, not all of your time is spent directly with clients. If you meet a client at Starbucks for, a consult, or you're at a shared office space because you rented a conference room, that doesn't immediately disqualify you from taking a home office deduction, but it's something you should consider. If you're primarily working at a co-working space and then you just come home at nights to work on the couch, that living room space may not be eligible for the home office deduction. Robert's asking, if you have a business address but is only for mail, all work is done at home office, is it possible to deduct the home office? Where you receive your mail is different from where you're actually performing the work. So if you're renting like a virtual address or a PO box and it's exclusively for business mail, that, fee could be deductible in addition to your home office. Is a simple home office calculation just $5 per square foot once or monthly? That's a great question that I don't know the answer to. I'm inclined to think that it's annually. Let me get back to you on that question. I'm actually not sure. I'm more familiar with the more complex deduction. Mary's asking, what about a room used for storage of product? So that may be a separate like rented storage space, not necessarily a home office deduction. Um, so the rented space could be a separate business write-off if it's exclusively used for business product. And then maybe you're, doing admin or having consults in your home office, in which case both would be deductible. What if, in addition to my business use, my spouse also has a fully remote work from home W-2? Can we both qualify? If she is a W-2 employee, she is not eligible for a home office deduction. If you have your own self-employed business, you would be eligible, but being a W-2 employee of another company does not make you eligible for claiming a home office deduction. Amanda, does the home office deduction include space used to store items for your business or only office space? Home office deduction is where you're performing the work. So if you've got, like an e-commerce business, you've got inventory stored elsewhere, that would be considered separately from your home office. Joel is asking if an LLC is registered in the US and owned by a US citizen who lives and works remotely from Mexico full time, but still travels to the US occasionally. And most clients are US based, can the business still elect S Corp status? And if so, is the owner allowed to deduct a home office deduction? So Joel's asking about S Corp eligibility and when there's international activity. The S Corp eligibility, it's listed, we do a separate webinar on who's eligible to make an S Corp election. If you're a US citizen or a permanent resident alien, you could be considered an eligible owner of an S Corp. Generally, working remotely from Mexico full time, I may have to get back to you on that one, Joel. There are some instances where having a physical presence internationally can trigger some complexities and different things to consider. So we'll get back to you on that answer. Glennis is asking, what do you mean by rolling over as a red flag? I may need more context for that, but when we did mention rolling over, we talked about the home office deduction. If the deduction yields a large expense, a large deduction, so large that it puts your business profit into a loss, the IRS doesn't allow that. It can't create, the business use of home deduction can't create a loss. So what that means is that additional deduction that you can't claim this year would get rolled over to a future tax year. Debbie's asking, I understood if you were an S Corp, you could do a marketing analysis of SF cost as a reimbursement from the S Corp. Debbie, I may need more context on that. It sounds like maybe there's a local tax break that you're looking into. I may skip that one and get back to you. Katie's asking for home office deduction. If you have two businesses, can you allocate home office deduction to one and co-working space to another? Yes, if you've got two eligible businesses and you meet all the qualifying factors for both instances, you may be able to deduct both. Alexandra, can you deduct areas of your home dedicated to content filming room or merchandise storage alongside home office or one or the other based on max square footage? Can you deduct areas of your home dedicated to content filming? Yes, the instance where this could come into question is that space exclusively used for filming and storage? If it's converted to, where your guests sleep, or it doubles as your kid's playroom, that's where there could be a gray area. So just document the use. If it's exclusively used for, filming and storage, then it could be eligible. David's asking, can a C Corp buyer pay for the home you live in? David, I'm just going to level with you. That is beyond the scope of this webinar. There are instances where businesses can buy, make an investment into a property. whether you live there as your primary residence could be another question, and there can be some implications on, where the deductions apply. I may reserve that one for later. Computer systems would be depreciative item, correct? So it depends on the cost of your computer system. If you've got like a whole facility of servers, the cost per unit may be over 2,500 per piece, then yes, that sounds like it would trigger a depreciable asset. And we're at time, but we've got 61 more questions. There's more coming. Thank you so much for the participation. We're going to keep going, so feel free to hang on. We will close out the webinar, but we're going to continue answering the questions and posting them to YouTube. So if you have to hop, no worries. We can catch you on YouTube or the next webinar. We're just going to continue on. Megan's asking, can I include my garage as home office space? As a farmer, I utilize half my garage and workroom for farming supplies and vegetables. A similar concept. If you can document, 50% use of that square footage of your house, there, it depends on if that garage is attached. Sometimes with detached units, it can get a little bit more complex. Generally, with farming, maybe there's a little bit of a different set of rules there. If you can document that it's exclusively and primarily used for storage, then it may become deductible. Amanda's asking, what would be the overtime traditionally be like 305 years? So Amanda's asking a question about what's the useful life of typical assets. For example, machinery and equipment is a 5-year useful life. So that, computers, this microphone, if you're a photographer, your cameras, 5-year business life for machinery and equipment, furniture and fixtures. So this desk, your standing desk, your office chair, generally those are 7-year useful life. So there's a set of rules. I think the highest that might apply to this group is a 39-year life of your home if you're taking depreciation under the actual method. Everything that you might normally buy that would be considered a depreciable asset will likely fall under a 10-year useful life. And then if you claim bonus depreciation, it's going to be deducted in the year that you buy it, rather than if you elect bonus depreciation, you can deduct the cost in the year that you purchase rather than spreading it over, that 5 or 7 years. Definitely not 305 years. Trevor's asking, he is an S Corp. Is the home office deduction done inside my business return, or do I do that over on my personal return? I've seen it a couple ways. You can, so your S Corp is going to issue a K1, and the K1 is going to show, it's got 2 columns of different types of items. Your home office deduction may flow through to your personal side where the actual deduction may be claimed, but you can report it on the S Corp return. So if you're filing an S Corp return, you'll want to consider your home office deductions getting reported there. There's also something called an accountable plan. So some of you may have an accountable plan that can impact how you deduct your home office and where. Maybe it's showing up as a reimbursement versus a flow through deduction to your personal return. Shelby's asking, how do I best keep track of applying these deductions over time? So bookkeeping software, whether you're set up as an S Corp, single member LLC, sole proprietor, any variation of an accounting software is going to help you keep track of eligible deductions. In terms of deductions that are mixed use, so they've got both business purpose and personal purpose, what we see work the best is you pay for mixed use purchases with your personal money, and then the deductible portion can get reported onto your business books. So maybe this is, doing a search in your bank statement for farmers insurance, and that's how you compile your annual homeowners insurance to apply to your home office deduction that can be recorded later. Jacqueline's asking, I am assuming the bonus depreciation for assets over 2,500 because of wear and tear. A saw that we use daily and may break. So a saw is probably less than 2,500. So it's an expensable item. To be honest with you, I don't know the rationale around, that $2,500 threshold in the IRS, but it probably has to do with how long you'll use it. That sounds reasonable. My LLC was officially created this year, but I bought my laptops last year. So will I use regular depreciation? This is a great question that we did not address. You can place in service an asset. So you want to place in service the asset in the year that you bought it, typically. So if you bought a laptop last year and you were running your business last year, you would have had to claim that deduction or put it in place as a depreciable asset last year. So really, depending on how you're set up and what's your taxable year, most often, if you're a Schedule C filer, you're a calendar year taxpayer, which means you claim deductions when they happened from January to December. If you're an S Corp owner, that's considered a pass-through business. So those typically mimic your individual filing calendar year. So in either instance, you likely had to have claimed that deduction last year. Amanda's asking, do we have to tell our accountant that we want it to be a leveraging bonus depreciation, or how do we ensure that it is considered that? So in a traditional like public accounting setting, you'll hand over your books to your accountant. Maybe they're already cleaned up. Sometimes they'll ask for a list of fixed assets that you purchased. Sometimes they'll look through your office equipment, general ledger, and they'll identify, items that cost over $2,500. They'll typically flag those and ask questions like, Amanda, was this one laptop? Was this a couple iPads? What was this? To help you determine if there's something that should be depreciable there. So generally, your accountant will be looking out for those items. I know from experience, they will appreciate if you just said, hey, accountant, here's my list of equipment that I bought this year that probably need to be depreciated. If you have a car, if you've got computers, laptops, that makes an accountant's job a little bit easier. But sometimes they're also digging through that general ledger to help you identify where those depreciable assets are. And we're going to go for 3 more minutes. We got a couple more questions we can ask. We still got 200 people on. Thank you for staying. Amani's asking, what makes something eligible for bonus depreciation? I'm immediately thinking of which items usually have limits. For this conversation, vehicles often have limits on bonus depreciation. It has to do with maybe the vehicle type. So think luxury vehicle. Maybe you bought, a Lambo or something crazy. That type of vehicle may have certain limits on whether or not it's eligible for bonus depreciation. Other asset categories that might be limited, like let's say you own rental properties and you're building out, commercial rental properties and you're building out improvements for the ice cream shop that's moving in. Those are considered leasehold improvements. Those may have disqualifiers for bonus depreciation. If you've got investment like real property, so residential real estate, those may be ineligible for bonus. Typically, if you're looking at furniture and equipment, computers, building out your home office space, typically those deductions or those asset classes would be eligible for bonus. Over the $2,500 threshold, vehicles are probably going to be the big item for the context of this conversation that may have certain limitations. Garrett's asking, what are the implications, if any, if you work part-time versus full-time? In terms of home office, if you're a self-employed individual and you spend 20 hours a week, that doesn't necessarily have an implication as long as your expenses and your space or your business vehicle is documented that it has a business use percentage or a business use purpose. Full-time versus part-time may not have an impact on what's eligible for deduction. Eric's asking, with regard to depreciation, what if a camera costs less than that $2,500 threshold, say an $800 camera body? You can expense it. So instead of having an asset on your books, maybe you've got on your chart of account something that says, small equipment, and that and that camera body would just get categorized in small equipment and just deducted like normal. We're going to do one more. Dolly is asking about bonus depreciation. Does this mean I can claim the item in full in my books the first year I buy it and then also claim it as regular depreciation? So that same year I also, okay, so this is a question about bonus depreciation and regular depreciation. You can't do both. So when you choose either or, that is the depreciation method that you're choosing for that asset. So yeah, you wouldn't double deduct. In essence, Dahlia, that's double deducting that particular item. I'm looking in the chat. Raj, you've asked an intriguing question. If I'm on family vacation but still working 8 hours per day at my hotel, could I deduct my driving mileage, my portion of hotel bill, food expenses? This may be considered a travel expense, but what is a flag to me here is I'm on a family vacation. So really what you're trying to determine, what the IRS would question, I guess this is how I would look at it. What's the risk in claiming this deduction? If you're on a family vacation, are your miles, are your hotel bill, are your food expenses exclusively used for business? Do they meet that test? The IRS can question things like family vacations and trying to claim a deduction. So, like any write-off, the best thing you can do is document and substantiate the best you can the business purpose so that if you are audited or if that deduction were to come into question, you can substantiate it. The risk here is that if you do claim it and the IRS doesn't like it, they're just going to adjust your tax bill and you're going to pay the additional tax owed. So that's the risk. I would say if you're on a vacation, looking to claim a deduction for a portion could be considered risky. Maybe there's an instance where you're on vacation, but you are meeting a business client. Maybe that meal becomes 50% deductible. Or maybe you're renting a co-working conference room while you're on vacation that's only for business. In that instance, that rented co-working space could be deductible. But be mindful, deducting a portion of the hotel, the driving, airfare, if you're on family vacation, could be a trigger for a red flag. Christine, it looks like you just arrived. This recording will be posted to YouTube and you'll get a copy after the webinar. We've still got 100 people, 180 folks on and 60 questions left. We are 15 minutes over, so we are going to call it there. Thank you so much for the engagement. This is huge. That shows us that there is so much to share, so much to talk about. So really appreciate all these great questions. We're going to do our best to get answers to you. These webinars, we've got them 2 to 3 times a month. So feel free to register for the next one. Follow us on, LinkedIn, Instagram, book a call if you're interested in getting an S Corp set up. And we'll see you next time. Thank you.